When it comes to investment results, Warren Buffett's track record is second to none. A $100 investment made back in 1964 grew to over $1.3 million by 2015 and is quite a bit higher today. Meanwhile, the S&P 500 investing that same $100 barely looks like it moved at all. Of course, it had a great run over that same time period, but Berkshire Hathaway has performed so much better. How did Buffett manage to do this over such a long period of time? Most people think of Buffett only as a value investor. He certainly was that in his early days of investing, but after he met Charlie Munger, he really transitioned his thought process to more buying elite businesses and holding them for a very long time. So what is it that makes a business elite? That's a question that Preston Hayes asked over in my school community. You can sign up for this community for free at www.school.com/investing. His question was, number one, what do you look for in an elite business? Number two, what are some ratios or metrics that suggest a business is becoming elite? And then what about some indicators that suggest it's no longer elite? There were 31 different comments on this particular question. In the first part of this video, I'm going to review what those metrics are. And in the second part of the video, I'm going to backtest how all of these quantitative metrics that the group came up with would have performed going back to 2003. And then in part 3 of the video, I'll reveal the 98 stocks that are currently on the screen. So first, what are the characteristics of an elite business that the group came up with? The first is obviously a subjective metric, and that is quality management. One person offered prudent capital allocation, which simply means, do they do a good job managing the business's resources? Are they reinvesting it back into the business at high rates of return, which would be a positive, or are they investing at low rates of return, overpaying for acquisitions, or things like that? Another subjective metric would be a strong company culture and history. The next characteristic of elite businesses is strong financial health. This is where we start to get into some very useful quantitative metrics for our screener. The first is no or low debt. In the screener, I filtered only for companies that had an interest coverage ratio of at least 5 times or more. That's calculated as earnings before interest and taxes divided by the interest expense. The next factor was the share count declining. In this case, I didn't necessarily look for share count declining. I looked for percentile rank across the entire US stock universe. So any company that's issuing a lot of shares is cut out. The top 75 percentile in terms of diluted shares outstanding increasing over time are still kept in. One member mentioned they looked for size when evaluating companies. I left all sizes in this screener. Another person mentioned they look for companies with high recurring revenue. That's certainly a very valuable component of a wonderful business. However, in this case, screening for them is rather difficult. We'd need to see more details in the financial statements, the 10K, in order to know this number. Another factor would be low research and development and capital needs. This one's pretty interesting. Basically, the idea is that if a company has to continually spend money on research and development and capital expenditures, the biggest offender of this might be like an auto manufacturer, for example. They have to build a lot of factories. They have to research and develop a new car model every single year, new car models in general. So to filter out these companies, I took the research and development expense plus their capital expenditures and divided it by sales averaged over a 5-year period. Again, I took companies that were in the upper 75 percentile, so basically eliminating the most capital intensive and research and development intensive companies. The next category, number 3, is consistent growth. And I noticed in the community, a lot of people were focused on consistency, which I absolutely think is the right thing. If you have a company that's just meandering along, basically earning the same amount of money, and then all of a sudden they explode because of some government policy or something, that is most likely not a consistently growing company that you can rely on in the future. What we want to see is a steady upward trajectory over time. So to do this, I ran a simple linear regression comparing the revenue per share and free cash flow growth per share over time. For the more positive the slope, the faster the growth would be. And then also the more consistent companies which I measured by R squared, those would also remain in. In both cases, just like the others, I kept the top 75 percentile. So we're really just eliminating the least consistent and the slowest growing companies. Next, we have scalable, which I also think is pretty subjective. So is growing industry or total addressable market. Again, something you're going to have to do in your own research. The fourth category, and probably most important, is a wide economic moat. There were a lot of good ideas here on how to find these kind of companies. One person suggested return on equity of 15% or more and return on invested capital of 20% or more. I did include both of these in the screen, but I flipped them. Typically, a company with a high return on invested capital of at least 15% is going to have an even higher return on equity since they typically have at least a little bit of leverage. So I used a return on capital of 15 and a return on equity of 20. Next, we had operating margin and net margin, both over 20%. And then another would be gross margins over 40%. I did include these into the screener, but just keep in mind that there are some businesses that I would argue are wonderful, like Costco, that have very low margins, but extremely high asset turnover, meaning that they're basically selling things at or near their costs, but they're getting so many people through the door that it adds up to a substantial amount of money and a substantial economic moat. So wonderful businesses can still have low margins. And then another subjective measure, which would somewhat be covered by return on capital and equity, would be barriers to entry. So what keeps their competitors from taking down some of their edge? The fifth category was only relating to dividend investors. I did not include this in the screen since not everyone is going to be a dividend investor, and that's pretty easy to screen for. Those that mentioned those said that they look for a low payout ratio. Some suggested a starting dividend yield of 2% or more, 15 plus years of dividend growth, and then a 10% plus dividend growth rate. All these are fairly solid. I would say dividend yields of 2% or more are probably appropriate if you're looking to generate income, but if you're a 30 or 40 or even 50-year-old and your long-term time horizon is another 30, 40, 50 years, growing income is more important than what the yield starts out with. Next, we have excellent products and services. This is also very subjective, but I did want to pull in this comment from Bailey Irwin, which I thought was actually really good. So he's the one that brought forward the R&D and CapEx, but I thought their points number 2 and number 3 were the most interesting. Basically, this relates to Buffett's circle of competence concept, which is if you have a business that you shop at a lot or you really love, chances are there are other people that are going to know and like that business as well. He talks about the soccer mom knowing when the next fad is. So typically, if a business is expanding its moat, that means that more and more customers, you included, are going to like to go there and use their products. When a company's losing favor, you're going to know that. So what would happen if we combined all of these metrics into a screener and then backtested that screener back to 2003? I did that over at Portfolio 123. If you're interested in getting access to Portfolio 123, I'll put a link in the description down below. It's a screening and backtesting tool that I actually use and pay for with my own money on this channel. This is how I set up this particular backtest. I'm looking for quote unquote easy to trade US, which is basically all US companies that have enough liquidity to easily buy them. I'm looking at this from January 1st, 2003, all the way through today, which is the 6th of September. And then I'm going to benchmark this against the Vanguard Total Stock Market Index. The rebalance frequency here is every 52 weeks. For those of you that know my channel, you know that my preferred rebalance frequency is every 520 weeks, but they didn't have that option. I set up this backtest filtering out all the companies that did not meet the criteria that we talked about in part 1 of the video. And these were the results, and they were actually quite impressive. So this would be the screen of stocks. It returned over this time period 1,234% if we round it up. And then the total stock market index returned 844. If we look at the annualized number, that works out to just about 1.5% per year in outperformance. However, that was also with quite a bit less risk. So you can see that the maximum drawdown was just 42.8% for this screen of stocks, compared with 55.5% for the S&P 500. This makes sense if you have a lot of high quality metrics in this particular screen. So the Sharp and Sortino, which are both risk-adjusted metrics, are both favorable compared to the S&P, and standard deviation slightly lower. Historically, this screen did a very good job getting you into companies that not only had a high chance to outperform, but also had below average risk. So which companies make the list today? This is going to be in alphabetical order, so I'm going to flip through these fairly quickly. But first, I wanted to share the different metrics that I'll be displaying on the screen. At the top, we've got price. Then we have sales over the last 12 months. Earnings per share over the last 12 months, we're excluding extraordinary items. Return on invested capital average over the last 5 years. And then at the bottom, we have dividend yield. I'll flip through these quickly, and if you have one that you're particularly interested in, you can pause the video. First, we have Agilent Technologies. Next, we have Apple. You can see that Apple has a steadily growing earnings per share over time. These are in logarithmic format, so you can see the consistency a little more easily. Typically, when you see something like this, both steadily increasing sales and earnings per share, and a steadily increasing stock price, there's a very good chance that you found yourself an elite business. Next, we have Adobe, which shows very similar, other than a pretty significant pullback in 2016. ADP is a model of consistency. Just look at that earnings per share over time. Allison Transmission, this one's been a little bit more erratic. Definitely very impressive growth in the last few years. Applied Materials, Amgen, Ameriprise Financial. This is another one that shows that very impressive, steadily increasing earnings per share. Arista Networks, ASML, Brown-Forman. One thing to note on Brown-Forman that you don't love is this return on invested capital average over 5 years has started to decline pretty significantly. That is typically a worrying sign and a signal that the business could be losing its elite status. BHP, that one is quite erratic. Biogen, this one has a fairly substantial rollover in earnings. You can see that the earnings really haven't grown going back to 2014, and they're on a negative trajectory. The Buckle, Booking Holdings, Blackstone, CoreCard, this one is also quite erratic. Cadence Design, this one's very consistent on sales growth. Earnings aren't quite as consistent, but sales and price growth both very consistent. CF Industries, that one looks quite erratic. Checkpoint Software, very, very stable growth. Colgate Palmolive, Cohen and Steers, Corcept Therapeutics, Copart, another very stable look, both price, sales, and earnings. Crocs, this is one that kind of had that big surge in growth. You can see that back in 2021, they had sales of $1.2 billion, and that is almost quadrupled in just 3 years. I would be a little skeptical of growth that quick. Kind of indicates that it could be just a fad, which probably is. Cisco Systems, Diamond Hill Investment Group, Evercore, EverTech, Edwards Life Sciences, Fastenal, another one that's quite consistent. FactSet Research, another consistent one. Federated Hermes, Graco, there's Google or Alphabet, Halozyme Therapeutics, Honeywell, Hershey, IDEX Labs, Intuit, Illinois Toolworks, James Hardie Industries, Jack Henry and Associates, Johnson & Johnson, Keysight Technologies, quite a bit of a roll here in revenue. Kalac, Coca-Cola, there's Lilly. It's crazy how consistent the price has grown and how quickly sales have grown over the last couple of years. Obviously, weight loss drug being a big part of that. Grand Canyon Education, Lam Research, Lattice Semiconductor, Lululemon, MasterCard, Manhattan Associates, Moody's, another Buffett holding, Monolithic Power Systems, Masabi Trust, Microsoft, National Research Corp. You don't like this huge drop in price. I'd be very wary of that, especially this huge run up and then huge run down. It's kind of a classic marker of an inconsistent business. North European Oil Royalty, NetEase, NVIDIA, NVE Corp, Novo Nordisk. Just look at that consistency and growth over time. Omega Flex, another big roll. Paychex, a Brazilian company, I can't even say it. Procter & Gamble, Qualcomm, QuidelOrtho, another huge surge up and surge down. Qualsys, Regeneron Pharmaceuticals, Relics, Rio Tinto, ResMed, Southern Copper Corp, SEI Investments, Siga Technologies, Semler Scientific, Snap-on, S&P Global, Sociedad Química, oh boy, I can't even say that, whatever, some sort of weird foreign company from Chile, I guess, Simpson Manufacturing, Teradyne, Technoglass, Texas Pacific Land Corp, T. Rowe Price, Texas Instruments, United Guardian, Union Pacific, Visa. I love the consistency of Visa. This and MasterCard both look very similar. Vail SA, price hasn't gone anywhere, not a good sign. Valueline, Vertex Pharmaceuticals, Waters, West Pharmaceuticals, Yiren Digital, and last one is the pet pharmaceutical company Zoetis. You can see it's also been quite consistent over time. If you want an Excel spreadsheet of all of these positions, I'll post that over on the free school community, which you can sign up at www.school.com/investing. I also wanted to announce that I just updated my book, Dividend Growth Machine. The second edition is now out. I just released it for sale a week ago. You can buy the book on Amazon. I'll put a link in the description down below. Thanks to everyone for watching, and I will see you in the next video.